Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. Scrolling through the comment section, wanted to comment on some more things here and get you guys my opinion. This is about real estate, and I know some people, a lot of the channel, they're really interested in uranium. They're really interested in uh, gold and silver, but I'm getting some more real estate people, and for some reason, the real estate people, a lot of the comments I get are anti, or maybe not anti. They're just opposite of kind of how I think, and that my viewpoint is too simplistic or whatever. But I want to comment on it and give you guys my opinion on it. It says, and here's some of the questions. It says, great video, Andy. In your opinion, if you had to sell in summer of 2022, 2024, and 2026, which do you think would catch the highest price, or would you not sell at all? So the way that I would answer that is that it's not dependent on time frame. It's dependent on the supply demand balance and how those are interacting with each other. You can see that through the inventory levels, the days on the market, and the prices. What you want to look for is you want to see inventories increasing and going above 6 months of inventory. That would be my indication to start looking to sell. And if you go above 6 months, you'll probably have a good year or two to sell. That's my take on it. You'll see days on the market going up, and you'll start to see home prices level off. So that is when I would be a seller of real estate. Here's another one. It says you make things too simplistic. It is not just a matter of supply and demand. Okay. Tell me how the average middle income young couple who wants to buy a home can afford to do so when the median price is $350,000 and rising, and mortgage interest rates to rise with inflation. The situation cannot continue for long, and the possibility of significant problems in the mortgage industry has to be considered. Well, my answer would be it is a matter of supply and demand. And I'm just going to make this really simplistic, because the more simplistic it gets, the easier it is to understand. If you have, I'm just going to make up a number here, okay? If you have 10 million families that want to live by themselves, and it could be rent, it could be owned, it could be anything. They want to live in their own unit. And in this society, you have 8 million places to live, but you have 10 million that want to live by themselves. What that means is that in order to balance this society out, some people who want to live by themselves are going to have to be priced out of that scenario where they're going to have to live with someone else. In that scenario where you have a 2 million home deficit in the total society of 10 million versus 8 million, 10 million families want to live by themselves, 8 million places to live. At what price does it make it where 2 million people are going to have to be priced out of the market, where they have to live with someone else against their own wants and desires to live by themselves? I don't know what that is, but I can tell you this. Homes under that scenario do not become more affordable. They need to become less affordable. Or you're going to have to raise the rates of existing homes where new homes become more affordable and people start to build more new homes. So it is a function of supply and demand. And you bring up a question. Tell me how the average middle income young couple who wants to buy a home can afford to do so. They need to be priced out. We don't have enough homes for them. That is what I'm saying. The affordability has to go down so people get priced out of this market, because we are short 5.2 million homes. And this is the pool. Doesn't matter if you rent or buy. We are short places to live at this time. Now, I can't tell you the interactions of the death rates of boomers and the formation of families in the millennials. I can't tell you that when exactly this is going to change. And I can tell you this, no one can. But I can tell you this, the interaction between the buyers and sellers results in inventory draws or inventory additions. So if people are dying faster than what families are being formed in young families, then that imbalance or balance will be seen through inventories. And if the inventories are at record lows, what do you think the price is going to do? Now, if you have a shortage in homes in general, what you would see is you would see rocketing home prices and rocketing rent prices. If the pool is too small for the families being gathered who want to live by themselves. And what do we see? We see that exactly. And people can afford it because that's the entire reason that prices are going up, is because people can afford to pay more for housing. And when you go into an inflationary environment, and this includes people like myself, it includes people like my parents, it includes people all over the place. When you have money and you have investments, what are you going to do with those investments? People might own 2 homes. Maybe they only own 1. I don't know. But I have to put money somewhere. And if real estate is a cheap alternative and a better investment than stocks, because stocks are in a bubble, I'm going to put money in real estate. So what do you think a bunch of rich people are going to do? They're going to put money in real estate. And I guarantee if you look at what rich people are doing, they're putting money in real estate. Doesn't mean that younger people can afford it. Investors can afford it, and the younger people are going to have to rent. And guess what? Their rent prices are it's going to rape them if they want to live by themselves. And what's going to happen is the price of everything will go up. And if the price of new homes continue to increase, the price of existing homes will continue to increase until you find a market balance that clears it all. It is that simple. So the people that are projecting that they can predict the future and what people can afford or not afford is the wrong approach, in my opinion. The right approach is to look at the inventory balances, to look at the pricing, to look at the interest rate may or may not impact the price of homes. What are you willing to pay if your option is to go live on the street and your family has to go live on the street versus living in a house? How much would you pay for that? And if it's 50% of your income or 70% of your income to avoid that, it's definitely worth doing. So I can't tell you what that looks like. What I'm telling you is follow the inventory. And you can do this with any commodity. Follow the inventories and see how those inventories are reacting to price. If the inventory is continually being drawn down, irrespective of price, price will continue higher. That is the basics if you want to follow any market in commodities. If inventories are going up, prices most likely will slow down their increase. And they'll hit critical levels, say 6 months of inventory for real estate, where prices may start to go down, because that's kind of that critical level. So I wouldn't try to project all these things. You can take it as information, but just because you may have someone's projection of people dying at some point may or may not happen that way. Look at inventories, and inventories will give you enough heads up to act anyway. You may have 2 years at a top. And then follow simple technical analysis. If you're charting things out in terms of prices, and we are at a huge deficit, guys. We're not even close to being in a balanced market. I don't think rates are going to do anything. Are rates going to help you? Okay, so let's say Let's say I can't afford to buy a house, but I need to rent. My parents pass away. I have no other income. What am I going to do? Am I going to put my family out on the street, or am I going to pay whatever I can to live somewhere? I'm going to pay whatever I can to live somewhere. That's my option. Now, if we have a huge shortage of homes, then it's whatever people can afford. If there's a shortage, people have to be priced out, and they're going to have to start doing multi-families in a single house. So we're at the point where people are trying to move out. They're trying to buy homes. And if your option is to rent versus buy, and I know many millennials, many from work and all over the place, they're buying like mad. Why? Because they see that there's a shortage. And if their option is rent at $2,000 or $3,000 a month, or buy at $2,000 a month and lock in my costs. So they're locking in the costs. I'm the oldest millennial, so I'm just in front of everybody. I'm just doing everything first. I'm figuring things out, and I'm doing it quicker than everyone else. I'm there first. So I get to pay the cheap mortgage rates. I get to refinance at the lowest possible time. I get to do all this stuff because, one, I educated myself in this. And if you guys educate yourself in it, you'll figure it out pretty quick too. Another one says, inventory will build through increased mortgage interest rates. How do you know that? How do you know that inventory will build through increased mortgage rates? Where in history have you seen that happen? Did it happen in the 70s? No, it didn't. Did it happen in the 50s? No, it didn't either. Where are you getting that? Interest rates do not build inventory, do they? Are the home builders leveraged off of mortgage interest rates? Now you are supposing, you are taking a leap of faith that interest rates will kill demand. The problem is, if you're short the pool of homes versus the pool of families, you're still getting bidding wars either through rent or through buying a house, or both. And we've got both going on right now. Interest rates don't build homes. And if the price of homes continually go up for new homes, the price of commodities, what do you think that's going to do to existing home prices? You think it's going to get cheaper? Now, interest rates is a form of affordability, but affordability doesn't mean that home prices go down. It doesn't necessarily mean that. We have not seen that in history. Show me a time where the pool of homes was still short and house prices went down because of interest rates. Do we have anything in history showing that? In fact, in history, what it's littered with is higher interest rates to increase the pool of homes, and the pool of homes increasing is inflationary. It's having an impact on interest rates. What drives interest rates is a real negative rate. It's inflation outpacing the interest rate. It puts it into a negative rate, which forces bondholders to sell. The real estate market is the leader. The bond guys are following off of the inflation that's been being kicked off of increased loaning in commercial banks from a fractional reserve lending system. So I would be very careful on what you just stated there with inventory will build through increased mortgage interest rates. That has not been seen in history. Inventory builds when you build more new homes. We are short 5.2 million homes, and this isn't going to correct itself very quickly, in my opinion. And notice that the medical event in 2019, 2020, when that happened, did it impact the crash, that whole crash? Did we need more new homes? We did, right? It's structural in nature. If that event couldn't impact it, then what will? Unemployment's through the roof. But yet, guess what? The supply-demand of imbalance in real estate continues to go higher. Real estate prices continue to go higher because of that imbalance. And unemployment can go up, and it's not going to impact it until we get the balance. It's trying to find that balance in the market. It says, which will arrest price increases and allow a healthier housing market to evolve. Who are you to determine what a healthier housing market is? And how do you know increased interest rates, which doesn't build more new homes, will result in a healthier housing market? The problem is your assumptions are, in my opinion, incorrect. And I'm not attacking you as an individual. I'm attacking your assumptions. Those assumptions, I think, are not right. Increased mortgage rates do not build homes. Unsaid in your podcast is the 40 to 80% increase in death rates in 2021 among 18 to 64-year-olds being reported by insurance companies. Draw your own conclusions as to why, as well as the natural retirement and die-off of baby boomer generation. The end of the C-19 government mandate madness will also stabilize the housing market and reduce the second home to flee to phenomenon of the past 2 years. Lower housing prices from higher rates will improve affordability for those who can afford a 15 to 20% down payment. All of the above supports a strong home building market while bringing home prices back down to earth. Well, I can tell you this, the price of new homes are higher than existing homes at this current time. And I don't know if increased mortgage rates will decline house prices and will bring inventory on. So I don't know if that assumption is right. And what I do is I don't try to draw conclusions like you did. What I try to do is I watch inventory levels and I look at days on the market and I look at prices. And if they continue to go up, I am going to say that they are going to continue to go higher because of inventory levels. And I don't need to necessarily know and try to project how the prices will react like you're doing. What you're doing is you're saying that because people have died, increased death rates, that somehow home prices will just naturally go down. But our inventory isn't saying that. Our inventories are still incredibly low. So what you have done is you've made a projection and you've drawn a conclusion incorrectly from the data. And I have an engineering background. What you can do is you can do the math, you can do all this stuff. And if you don't see it in your research and development, you can't draw that conclusion. You can have things that you can make conclusions before testing it, but if your testing it is opposite of what your conclusion is, it doesn't mean that your conclusion is still right. What I do on this channel is all I do is I look at inventory levels, really. And then I see if they're continuing to either draw down or go up. And prices are a function of where inventories are at. When you look at just the supply demand, everything gets risen up through inflation, which is just more money or credit in the system. It is that simple. So be careful on the conclusions that you draw, and inventory going up will give you probably a year or two of heads up notice to sell if you're trying to game the market. But at this moment where inventories are at, I do not think that home prices will go down because of where the inventory levels are at. And the market has a lot of momentum behind it. So I think that they will continue to go up until inventory levels normalize. And that may take years. And inventory will normalize when you build a lot more new homes. So the pricing is being priced based off of the inflation of new home costs. That is kind of where my thinking is. Real estate is cheap to other assets like stocks. If interest rates go up, what's going to happen is you're going to get a flood of money being sold out of stocks and bonds and rotating into inflationary protected assets like real estate. The money has nothing to do with what people can afford. It deals with where money is going to rotate from and to. So if real estate's a good investment based off of the valuation, and it's also in US dollars, which is a stronger currency at the moment than foreign currencies. Foreign investors will buy homes in the United States. People with lots of money in bonds and stocks will rotate and buy real estate and commodities and other assets that protect against inflation. So it's bigger than just people being able to afford it, and they can rotate that money in for inflation protection and rent the place out. So that's my opinion, guys. Thanks for listening. So, give me a thumbs up for the content. Subscribe to the channel if you haven't already. And thank you for listening. This is Finding Value.